What's up, guys? It's been about 2 months now since I first posted the video breaking down my portfolio, and I've been buying aggressively since about March, April, when we saw the market just crash due to tariff fears, economic data just being poor. Everyone was uncertain, and I was buying because I've seen this too many times. And here we are 2 months later. The S&P 500 broke all-time highs and closed there. QQQ did the same thing. Cryptocurrencies are through the roof. Everything has gone up since then. That just goes to show you that when there's fear and people are selling, that's the time to buy. Now, in this case we're in right now, where things are hitting all-time highs, greed is getting higher. This is a time where I'm thinking about taking some profits, and I'll go over that with you. As far as the economy is going, it's slowing down. So today, I'm going to go over the latest CPI data, the future PPI and jobless data, what it means for your money, and of course mine, as well as what's in my portfolio right now, my biggest wins, what I'm doing with my profits, as well as what I'm planning to do when it comes to managing my portfolio for the upcoming year, 2 years. And of course, that's going to change depending on data, news, big macroeconomics. So let's dive right into it. This is my realized profit and loss section here. So these are positions that I've already closed out. For the most part, they're good companies that are just undervalued, as well as some swing trades and day trades. Robinhood, obviously, big fan of the company. I use them as my main trading platform. Very easy to use, very user-friendly, and the company is just amazing. I think their financials are great, and they're just so innovative. So definitely was in Robinhood. AMD, another company that was undervalued for a while, and it finally recovered there. ASTS, one of those new names out there that's interesting. Of course, Tesla. NVIDIA, I just wish I bought more of that. There was so much fear over this DeepSeek news, and the stock went all the way down to like $84, $85. It's up $100 since then. SOXL, that's a leveraged semiconductor ETF. Great way to get into all of them if you don't know what to buy, if you don't know whether to buy AMD, NVIDIA. SOXL, the top holdings for this leveraged ETF include AMD, NVIDIA, or Broadcom. So if you don't know which one you want to buy, SOXL will give you exposure to all of them. And it's leveraged on top of that. 3 times leveraged. So you're exposed to basically the biggest semiconductor names and triple leveraged. Whenever you see QQQ or SPY, it's going to be day trades for the most part. Rocket Lab, Tesla, and again, SOXL. QBTS, one of those interesting companies that are coming out with this quantum computing. We'll see where that goes. That and RGTI is a big one. Roku is a company that I was never really interested in, just because I don't really use it, don't know much about it. But I saw that Cathie Woods was holding Roku as her second largest position like a year ago almost. I don't know if that's still the same, I haven't checked, but since she held so many shares of this company, it made me want to look into them. And financially, they're great. I'm surprised. After reviewing their financials and looking at the valuation, I decided to buy some calls. They cost $4.35 at the time. They ended up $13.15. So 200% gain. Thank you. Thank you, Cathie Woods. I appreciate it. Google, of course. You know how much I love Tesla. Day trade there. SPY. Even though I love Tesla, if it's dropping, might as well make money on the downside as well. It's volatile. I typically don't short Tesla unless it's a quick day trade and the market's just collapsing. It tends to just fall hard. But it also rises very hard. That's why a majority of my portfolio is Tesla. Then HIMS, another company that I've liked for a while. I think we're going to start seeing, we already are seeing a lot of telehealth nowadays. Some day trades here. Sold some calls on Robinhood when it was extended to keep a premium there. Surprisingly, Amazon, not the recovery I expected from them. Even today, still kind of lagging, I feel like. They're just a dominant powerhouse here. Robinhood and Amazon, these are just companies that I use. They're just widely used, I think, by everybody. I don't know anybody who doesn't have packages every single morning from Amazon. Can't complain. Now, if you look at the majority of my positions, like, Pepsi here, like Robinhood, if you notice the expiration date is 2027 for a lot of these, because I didn't know where the market was going to end up, how long it was going to take for these companies to recover. But I did know these companies were going to recover. There was a lot of red days waiting for these stocks to recover, but it ended up being worth it. But I put enough time on it where I'm not really stressed out. 2 years. I think even the 2008 recession didn't last that long. So I considered that safe. Especially because tariff news are really overblown, I believe. Yeah, inflation is the biggest concern. Almost everyone I know is saying that their money is not going as far as it used to. Things seem very expensive. Yeah, so I worry about inflation because that is more concerning to me than anything. And just talking to people every day, and I see a lot of patients daily, friends and family, and almost everybody's complaining. Even people with very high paying jobs still are complaining, still having trouble buying homes. That credit card debt is through the roof. Car loans are through the roof. Defaulting on loans is through the roof. Now, I'll explain why I was so confident that buying contracts in 2027 was safe. Okay, so here's the SPY chart, and these are 12-month bars here. So each bar is 1 year. And here was the crash right here, January 2008. Then here's January 2009. And then here's January 2010. Closed at $125. And when this started, what are we at? We're at, it closed at 90, but it was a high of 146. So it's 2 years later, we're $20 shy of the peak of the stock market, pretty much. And within 2 years, we gained almost all of it back. So if you bought anytime within this year, you would have made a lot of money. You could have bought anytime here. This thing would have just skyrocketed. I mean, we're talking, what was low? $67. Now it's $644. This chart is crazy. This is a crazy chart. We have been just flying upwards. We haven't had a red year since 2022. COVID, another beautiful time to buy. This is why I like to buy crashes. It was a low of what, $218. Could triple your money. Again, every time we crash, we just rally back up. So this is my current portfolio right now. It's showing 69,000. That's because I withdrew 41,000, and I'll show you. I did this withdrawal because a great business opportunity came in. I was happy and glad to join in on this business venture with one of my close friends, really almost like a brother to me. I'll give more details about what this business is once they get going and open up. That's always the goal too, to make money and buy income with it. Especially given the amount of hours I work, I'm not able to manage a portfolio full-time yet because I'm in the office working 50, 60 hours a week. So it's good to have some passive income too. I like to be a part owner of lots of businesses where I'm able to just have an extra check without having to do any work. Opportunities such as investments in startups don't come very often, let alone it coming from a close friend, almost like family. I mean, just ideal. Of course, there's risk with any investment, but it's better not to put all your eggs in one basket. That's why my account is reduced. I was glad to sell so I can reduce the amount in my portfolio and kind of diversify. And what I'm currently holding, of course, now this is by largest position sizes. So Tesla is my largest position. Next is Robinhood, TSLL, which is double leverage Tesla. And if you can see, almost everything here is 2027. Plenty of time. Apple finally made a decent comeback. Google, Amazon again, surprised, but it'll catch up. Tempest, Alibaba, this is actually a new position. Looking at Alibaba, it's one of the few ones that I have that expire in 2026. And I'm just looking for that breakout. It's due for a breakout. And I've only held this for what? I bought it on August 12th. And it's already up 40%. So we're talking one day. Recording this right now, it's technically August 14th, but the market hasn't opened yet. It's 1:15 a.m. Looks like it dropped overnight. We'll see. I mean, things are dropping overnight, and I figured that's the case because of the PPI data coming out tomorrow. That's also why I reduced some of my positions today. Trade Desk, another company that just dropped after bad earnings. I bought some of those, again, 2026, because I don't plan on holding that long term. And just some household names like Nike, Uber, companies that were just undervalued for a while. CRISPR is a cool company that does gene editing. Another one of Kathy Wood's favorites right there. And then just some smaller positions, more speculative plays like Grab has a lot of potential. It's a company that has a lot of dominance in Asian countries. Enphase, another one that I bought that's a potential short squeeze play. Some GameStop 2027. Not the biggest fan of GameStop, but these calls were cheap and people still love the company for some reason. So why not just have two calls, see what happens. Webull, interesting. Sonhorn. Now, these are just smaller positions here. A lot of these small companies that have possibilities of growing quickly. The good thing is with these companies, a lot of time. 2027, not concerned. And then these last two here are calls that I've sold. Let's look at some of the data that came out. We have the inflation data that came out August 12th, and the core inflation was 3.1%. And this is the fastest pace in 6 months that it rose. So that's concerning. What we have on Thursday, August 14th, is the PPI data and jobless claims. This is going to be significant. So what does PPI mean? Producer Price Index. This measures inflation on wholesale and production level. Excess pressure on wholesale and production leaks into consumers. So we end up paying a price as consumers if manufacturing, production, the companies making products for us are getting hit. We end up paying. Jobless claims, of course, that's going to be another thing that comes out on Thursday as well. And we know people losing jobs is always a red flag for growth. So if PPI is increased, that might reinforce inflation worries. So that might actually delay rate cuts. But everyone thinks that rate cuts are inevitable. I think I've seen a poll that said 94% chance of a rate cut coming up. We'll see. You know, when I first saw this, that CPI is higher, inflation's higher, I assumed that if inflation's high, they'll cut rates, which apparently is not the case, because if inflation is high, the Federal Reserve actually avoids cutting rates because lowering rates would make borrowing cheaper, which would stimulate demand and cause prices to push even higher. So basically like throwing gasoline on a fire. So if you get lower rates, people are going to borrow more money. They're going to have more buying power. And then prices will just go up because there's more money out there. If the Fed's job is to keep inflation under control, they'll have to keep rates high. If that's the case, you know, bringing it down to their target around 2%, which is interesting because everyone seems to think that we're going to get the cut, and the polls are pretty high. This is actually pretty funny. There's a countdown until the next FOMC meeting. So 34 days we'll find out if they cut rates. The chance of cutting rates is, I was saying it's 95.8%. Target probabilities for September, 95.8%. And I think this right here is why, even with poor data coming out, the stock market is still rising, because the expectation of the rates being cut in September, if the Federal Reserve cuts rates, borrowing costs drop for mortgages, credit cards, business loans, almost everything. So again, cheaper borrowing equals more spending and more demand in the economy. Lower rates push stocks higher, but weaken the dollar. Vanguard now recommends about a 70% bond allocation, signaling that they have concern over long-term equities. Although I don't really listen to a lot of mainstream sources. If we were all listening to the mainstream sources for investment advice, you would have sold back when everything crashed and bought back in now at all-time highs, which is the opposite of what you're supposed to do. It should be the other way around. You should always be buying at a discount, selling when prices are high. I'm going to be holding about 50% in cash of my portfolio and 50% in the market, and kind of seeing what happens. If things continue to rise, the economy looks better, I'll go back in fully. If we get a big drop and we have recession worries and the stock market crashes, I'll be happy, because every single time we have a drop, there's a recovery. I actually get very excited when things crash because I know I'm buying cheap. Look at the long-term trend though. If you don't want to deal with the headache like most people, you can also just buy and hold. I'd still look for a pullback. Problem is you just don't know. You don't know when it's going to pull back. You don't know if it's worth it. That's why a lot of people who just invest passively, like in a 401k, will just buy monthly or buy every paycheck they get and don't have to think about it. And that's still a good strategy. I'm not against that at all. But who wants to wait till 65? Thank you guys for tuning in. I appreciate all you guys. Stay tuned for more videos.